Good day, everybody. Today we are going to study something about the Bollinger Bands, how we can use it as a beginner or effectively. As a beginner, but effectively. The Bollinger Band is used to predict turning points in the market, and the Bollinger Band has the middle band, which is the 20 SMA, and also the upper band, which is the 2 standard deviation that is above, and also the lower band, that also is 2 standard deviation below. Let's go to the setup and then bring the Bollinger Band onto our trading platform. Just go here and then go to indicators and then go to the main chart and then add the Bollinger Bands over here. You don't need to do anything over here. The only thing you have to click on is the done. You're going to see the default settings because the several settings are already done. You come back. Yes, we can see it over here. So this is our Bollinger Band over here. This is our Bollinger Band over here. It's a Bollinger Band over here. Most beginners will see this and say, hey, good opportunities, because they said I should buy from the higher band. I should buy from the lower band and then sell at the higher band. So this here I can buy at this band here and then sell at this top here. Sell at the top here. Look, if you do that, you're going to lose all your investment capital. This is why you need to follow this system very well as a beginner. You have to know the idea. The idea is that if the price is moving away from the middle band, some point they are going to reverse back to the middle band. So the standard deviation is used for the outer bands. Bollinger's squeeze are also important over here, because let's look at this one. When we look at the Bollinger squeeze, is when the market is being in range. When the market is in range, we say the Bollinger Band will be squeezing the market. There will be a squeeze. I want a typical squeeze so that you can see there's a typical squeeze over here. Look at it. You see the upper band here and then the lower band here squeezes into the middle band over here. That's what's called the squeeze. So you can say it started from here. It started from this level and it was ranged from this level. And then we have what we call the Bollinger bulge. Anytime there's a squeeze, immediately after the squeeze, you will see a bulge like this one. A bulge is when the market moves outer the Bollinger bands. That is outer the either the upper band or the upper band or the lower band. So here it's moved towards here it's only moved towards it's only moved towards the lower band. So that is over here. It's only moved towards the lower band over here. Also remember that the Bollinger Band is not perfect because it is made up of moving averages, and all moving averages are lagging indicators. When you spot a bulge, it is likely that the market is about to change a direction. Remember, always bulge changes the direction of the market. Or when you spot a bulge, know that the market is about to change. The direction of the market is about to change. That is going to be in a trending form. Because anytime there's a range and there's a breakout, the market trends. Normally, the market moves in the direction of the bulge, but not always. You have to know that always that the markets move in the direction of the bulge. For example, if this bulge, the bulge went down, so it means that we are going to have a downtrend. But it's not always that we are going to have a downtrend. It is not always that we are going to have a downtrend. It is not always. Sometimes it can go on uptrend, on uptrend. So let's look at our strategy over here. When we are looking into this strategy that we are going to use over here, we don't just trade anything that we see on the Bollinger Band. But what we do is that we look into the Bollinger squeeze, and then there's going to be a turning point into a Bollinger bulge. This is a Bollinger squeeze. You look into it, wait. When you see it, just look into it, just wait, so that when there's a turning point that turns into a Bollinger bulge, that is where you are going to take your prediction, and then the market is going to move towards that direction. So immediately when you say there's a Bollinger bulge, the market is moving towards that direction. As I said earlier, the Bollinger bulge can either go up or can either come down. It depends where the market moves towards, into the particular band or into the particular band. So always use the Bollinger Band with a trend. Look for a trend. Always look for a trend. Don't just trade anything. Just look for Bollinger Band with a trend. And I said you can spot a trend. You can spot a trend when there's a bulge. So trade Bollinger Band entries with the trend. So let's look at our strategy over here. With our strategy, we'll be adding the RSI. The RSI, this is the RSI, but you can just go here and add the RSI to it. You go to the main chart, then select an RSI over here. Select the RSI, the relative strength index over here, and then you add it to the chart. You come back, then now you come and add the MACD. You can also add the MACD also to support it. So we just come here, then add the MACD also to support it. So just go to the main chart, then look for MACD. So this is the MACD. Then you just tap on it, and then come back. You see that they are all on the charts now. They are all on the chart. Use the default settings. So now this is our Bollinger Band. So we can see that there was a squeeze here, and then there was a bulge here. There's a bulge, so you just use the bulge over here. That is the bulge is the one that is going close to either the lower band or the upper band, but this one is going to the lower band, so that we have a downtrend over here. So you wait, let the market come back and hit the upper band. So let's see. Yes, here the market came here to hit the upper band over here. So we can put our sell trade over here. When we put our sell trade over here, with the first trade we lost. Why did we lose? Because at least when the market touches the upper band, we are going to put a trade over there, and then the trade is going to be, the stop loss is going to be 3 times lower the TP. So if you look at this stage, our TP, our stop loss here will be hit automatically, to be hit. So there's no need for you to calculate it. For it to be hit. So just wait. Don't relax. Don't worry. Just wait. Relax on this one. You could say there was even another bulge over here. There was a little squeeze over. There's another bulge over here. So you wait. Wait again. It hits over at this level. So you can put your entry over here. Immediately when you put your entry over here, you could see that it came down all the way to your TP. Then you take your profit over there. Take your profit over here. Now, what is the use of the RSI and then the MACD? It is simple. The RSI and the MACD are performing the same function. Just that the MACD is just confirmation. It's just to confirm that is the market moving uptrend or downtrend. Is the market moving an uptrend or a downtrend? That is all what the RSI and the MACD are doing. So you can see that if the market is moving at an uptrend, you said the market is always above the 70 level of the RSI, and here you see that the MACD range is always above it. But here we could see that yes, it was a distance, it was an uptrend. So here we could say there was a bulge here, there was a bulge over here, So we will wait. The RSI is pointing down, so we wait. Immediately when it touches with the bulge, we put our entry over there. So you can see that the entry just came down and it hit our TP for us, because the RSI is telling us that we are the down level, we are the down trend. So you wait again for our next entry. Our next entry also came, and then did it touch this level? No, it did not touch. So we can put our, yes, here it touched this level. So here we can put our entry over here. We can put our sell entry over here. So maybe when we put our sell entry over here, it just came straight to TP. Somebody will ask, what should be my TP? What should be my TP pips, or what should be my stop loss pips? It is simple. Normally, I want to waste 20 pips on stop loss and then 60 pips on TP. So here like this, if I should enter the trade here, because it touches the green line, touches it, or the green candle touches the upper Bollinger Band, so I'll put an entry over there, and up of it I'll put my stop loss around this, which is 60 pips, which is 20 pips, and then down here I'll set a 60 pips around at this level, and then I'll take my profit. So let's see another one again. So let's see, our this thing is showing us that there's a squeezes over here, but they're still at a downtrend. So we wait. Here it hits over at this level. It hits at this level. We put our 20 pips stop loss, and then 60 pips take profit over here. We won. It is simple, guys. It is simple. 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 Only just make sure that you are spotting the bulge, or you first of all make sure that you look into the squeeze. After the squeeze, there will always be a bulge, and then when there's a bulge, you put your entry over there, and that is all that it is. Thank you guys. Thank you guys. Thank you guys. For example, if I'm supposed to enter a trade here, I'm going to put a sell trade over here, and then put my 20 pips above, and then my 60 pips below as TP. My 20 pips above is for the stop loss. My TP is going to be 60 pips down here below. Why is it so? Because the RSI is still showing that we are in a downtrend, and then the MACD is also pointing that we are still at a downtrend. So I just do that. I just follow it that way. Thank you guys. Thank you guys.